Planning to retire soon? I've got 3 tax moves you have to make in the year that you retire. That and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Many people think that tax planning gets easier when you retire, and I would argue the exact opposite. You have more influence and control over your income sources in retirement. Therefore, tax planning gets potentially more complicated. In fact, I wouldn't even take the bait. Tax planning is vitally important during your working career and when you retire, okay? There's no time to take your eye off the ball. Tax planning is all about helping you identify the opportunities for you to pay the least amount of tax over your lifetime. And I'm going to share some of those opportunities with you right now that you should consider in the year you retire. Now, just before we get into it, well, these are opportunities. Well, are these the ones that you should go after? Well, doing comprehensive financial planning, looking at all 6 areas of your financial life, that's what determines whether these opportunities are the ones that you should pursue or one that you should avoid either temporarily for that year or until circumstances change. So tax planning, identifying opportunities, financial planning, capturing those opportunities, going after them. So in the year you retire, it's a unique situation with your taxes because most people don't retire right at the end of the year. Most people retire midway through, either in the spring or summer, or at their birthday, or so rarely do people retire right at the end of the year. And therefore, from a tax planning standpoint, even if you do retire right at the end of the year, I got a client that did just retire at the end of the year, had a little bit of income spill into the next year. And so the whole point is, in this year, at the end of your your long working career, when you've got a part year of income, what are the big tax strategies that you need to consider? 3 of them. First, in the year you retire, max out your 401k. Max out your 401k. Most people don't think of this for 2 reasons. Number one, they are just comfortable and used to saving 10% or 15%. And so they just stay on that rhythm, even though they're only going to work until, a partial year. So for 4 months or for 8 months or whatever. And that contributing 10% or 15% doesn't allow them to max it out because they're just staying on that normal pace. Well, if you're only going to have wage income for part of the year, increase your contributions so that you can max out that 401k before you're unable to for the rest of your life, okay? So the reason why you want to do this is it's your last opportunity to shelter dollars into that 401k. Your 401k is for most of us, it's the largest contribution limit, the largest tax shelter that we can fund. And this is your last opportunity to fund it. Therefore, from a tax standpoint, you want to shelter as much money from taxes as possible. So you got to max that thing out in the last year that you work, in the year that you retire. The other thing that I would point out, and another reason why people don't think of this, is they think, well, I'm about to venture into retirement, therefore I'm going to be walking away from my income, so I need to hang on to more of this cash. I don't want to defer it. I need to hang on to more of this cash. And ideally, you actually have already got a plan for that. And these dollars that you're funding into the 401k and the year you retire are some of the last dollars that you'll need. Therefore, you should be saving ideally aggressively, even though you think, well, no, wait, I'm retiring in April, so the money I contribute in January, February, March, I might be starting to draw that out in April, May, and that year. No. If you build up all of your assets, if you spend your working career building up assets and then you retire at this point, you're not going to spend all of those immediately when you retire. Instead, turn those on its end, and you'll spend a little bit over time. So those last dollars that you save into the 401k during the year you retire, those should be kind of at the far end so that you can invest them still aggressively and buy in through dollar cost averaging, buying more shares at lower prices. Therefore, continuing to max out your 401k even in the year you retire is the first and a fantastic tax move to make. Second, for similar reasons, max out your Roth IRA and possibly spousal Roth IRA as well in case your spouse is already retired or not working. So again, similar reasons, it's your last opportunity to do so. In order to contribute to a Roth IRA or even an IRA, okay, you have to have earned income. You have to have wages, paycheck money. Social Security doesn't count, a pension doesn't count, capital gains, dividend income, that stuff doesn't count. You've got to have earnings, wages, and therefore this last year that you're working is likely the last time you'll ever be able to make a Roth IRA contribution unless you go back to work part-time, something like that. And again, you want to maximize your tax shelters before you're unable to use them again. So maxing that Roth IRA, if you've got the right cash flow, you've got to look at all 6 areas of your financial life like I already mentioned. If you've got the cash flow and you've got the resources, maxing out that Roth IRA in that last year that you work, absolutely something to consider. One other point with maxing out the Roth is many people that have been working in their career for a long period of time are earning, have their tax situation where they're unable to contribute to the Roth IRA. I shared that in order to contribute to the Roth, you've got to have earned income. That's at a minimum. But you can't have too much adjusted gross income, okay, AGI. And depending on your income sources and your career, all that sort of stuff, many people later in their career, their income is too high. It's above that threshold. It's about $240,000 married, filing jointly. If you make above that, if you're not just make, if your adjusted gross income, modified adjusted gross income is above that, you can't fund a Roth. You're limited and then phased out completely. And in the year that you retire, again, you're only going to have a partial year worth of income. And so for those of you that have wanted to fund a Roth, but you haven't been able to, maybe you've been doing backdoor Roth, in the year that you retire, your income likely and could be below that threshold, allowing you to fund that Roth and that spousal Roth. And then the third tax move to consider in the year that you retire is on that same theme of the Roth IRA, and that is consider doing a Roth conversion. Couple reasons why this is an opportune time to consider it. Number one, you're still young. You're still young, and you might say, well, it's the end of my career. I'm not young. I was young in my 20s. Well, yeah, that's hopefully 20-year-olds right now watching this are funding their Roth. But it's the youngest opportunity you've got. You've got all of retirement, 2 to 3 decades ahead of you. Doing a Roth conversion now will give those dollars a couple decades, like I said, to grow tax-free. Second reason why the year you retire is an opportune time to consider a Roth conversion is, again, partial year of income. So as long as it doesn't push you into the next tax bracket, it may be worth considering. And then the final reason is, unless you're retiring at 65 or a little after 65, likely you don't need to worry about IRMA, income-related monthly adjustment amount, and you can do a Roth conversion where it's not going to impact the amount that you pay for Medicare Part B and Part D. If you are retiring, remember that IRMA, the amount that you pay for your Medicare Part B and Part D, is dependent upon the prior year. So if you just heard me and said, oh no, I'm great, I'm retiring at 64, no problem, I'll do a big Roth conversion and not have to worry about it. No, it will. That will impact you. It's the prior year. But if you're retiring at 62, or depending on when your birthday is at 63 or 61, considering doing a Roth conversion at that time can allow you to get more dollars on that Roth side of the equation, growing tax-free. Even if you are retiring at 65 or after age 65, one of those things, again, when you're trying to determine how much Roth conversion to do, let's hope it doesn't push you into the next tax bracket. That'd be one objective. And another one, we do this all the time, is, well, how much can we convert without causing you to pay IRMA in a year and a half or 2 years? That can be another threshold as well. So those are 3 tax moves that you need to consider in the year that you retire, uniquely set up for the changes and tax changes that occur during that year. Ongoing tax planning, though, that's part of the 6 areas of your financial life. You need it in your 20s, 30s, 40s, all throughout your career and all throughout retirement as well. Looking for and finding those opportunities for you to pay the least amount of tax over your lifetime, plus avoiding surprises as well. That's what tax planning is all about. Work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us there as well. Or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.